Well, order, and welcome to this Treasury Committee evidence session. We're going to hear from Clare Lombardelli, the new appointee as Deputy Governor for Monetary Policy at the Bank of England, before she takes up her role on the 1st of July this year. Ms Lombardelli, we've seen your CV and we're publishing the response to the questionnaire simultaneous to this session. And I want to just start by asking you to introduce yourself for the record.
Well, hello, I'm Clare Lombardelli. I'm currently the Chief Economist at the OECD, and I'll be Deputy Governor for Monetary Policy from the 1st of July.
Congratulations on your nomination to the role, and it looks like you're going to have your hands full, because the Bernanke review that was published last week has said that the Bank of England's forecasts have deteriorated significantly. You're currently Chief Economist at the OECD. Why have the Bank of England's forecasts deteriorated significantly?
Yeah. Let me start by saying I think the Bernanke review is a fantastic thing to have undertaken, in the sense that clearly, central banks around the world, particularly in advanced economies, have really had to deal with a number of shocks that have been very large and quite unusual in nature over the last few years. So when you look at the performance of central bank forecasting in terms of how it's compared, the estimates have compared to the outturns, we've seen very large errors across all advanced economy central banks. And actually the Bank of England's forecasts are sort of in line with that. As you would expect, really. All central banks in some ways, they use similar tools and approaches in the way that they do forecasting. The nature of the shocks that have hit the global economy over the last few years, if you think in particular of the COVID pandemic, and then also about the energy price shock and the cost of living, the impacts of inflation on that, have been difficult for standard economic models and forecasts to sort of handle and deal with, and that's why we've seen these very large errors across the piece. I think it is a good thing that the bank have opened up this process and had this review, and in bringing in Dr. Bernanke have brought in someone obviously of sort of outstanding ability and judgment on these things, and so I think very valuable. But ultimately it's really around for all central banks, really, it's been around the scale of these shocks and, in a sense, the inability of the usual models and techniques to be able to understand how these relationships have changed in the economy in response to these shocks, and some of the structural changes that we're also seeing going on. So that would be, why we've seen these big errors.
Well, what I think I'm hearing you saying is that you think that there's been too much reliance on models, and these models have turned out to have significant shortcomings. This committee was able to observe in real time, without the benefit of hindsight, but we were able to observe in real time the inflationary pressures that existed coming out of the pandemic. And the bank felt that they were transitory because the models said that they would be transitory. Now these models have been shown to have significant shortcomings. Do you think the whole process is too reliant on models?
I think, actually, I'm not sure I would necessarily agree that, in a sense, the process was too reliant on models. I think quite a lot of what has happened, in a sense, is, these models clearly couldn't, in a sense, cope with or weren't providing very reliable estimates of what the impacts of these shocks would be. And actually what you saw in policy making around the world, and I think this is also true of the bank, is actually because the models weren't providing hugely reliable forecasts in some instances. Increasingly, policymakers were using judgment and other forms of data and other forms of analysis, or other or trying to estimate other parts of models, look at relationships in a slightly different way. So I think, in a way, perhaps actually less weight was being put on the models because they were struggling, if you like, in this environment. So I don't know individual policymakers on the Monetary Policy Committee what weight they were personally putting on models versus data analysis, the information coming in from agent surveys and the like. I suspect that will have changed over the course of the last 2 years. But I think it is definitely the case that we need to be... we need to understand that models add a huge amount of value and they can do a lot in economics, but they also have their limitations. You know, I experienced this very much actually when we were going through the COVID pandemic from my role in the Treasury, and I've talked about this before. You have to use, you know, there is a role for models. They're very, very important. They can add a lot of value. They can really help you think about the relationships in an economy, and you can use them and compare that to what you're seeing in the real world, and that helps you understand, but you can't be overly reliant on them. I mean, ultimately, the economy is an incredibly complicated thing, and no one model is ever going to be able to replicate that and help you there.
In your role, as I understand it, you're going to be the person responsible for implementing the 12 recommendations that Dr. Bernanke has outlined in his report. I mean, one of them is that the software itself is just horribly out of date. I mean, he did not hold back in terms of his criticisms of the software. Is that something that, in your role at the OECD, you know, you feel very confident that you would be able to address those software shortcomings?
Yeah, I'm sort of hugely excited to be taking on the opportunity of reforming the modelling and how those models are used in the Bank of England. I think it's a great opportunity for us to improve policy making and communication. In terms of the software, I mean, I'll have to be honest, I'm not close to the detail of the precise software that the bank is using and the reliability of it and the state of it and its suitability for the modelling yet. You know, as you said, I don't take up my role until the 1st of July. I understand the bank is and has plans to improve its software, and obviously that will be a core part of the response to the Bernanke review. And you know, I'm confident that we will have the sort of resources and the capability to do that. In terms of what I've seen from the OECD and modelling there, I mean, we do our modelling in quite a different way, and we use it in a sense, less data per country, but more data around the world, if you like. So we get less into some of this country-specific details, but we do, for example, have an awful lot of data and analysis that we do on some of the global issues. So, for example, we have very sophisticated trade data that comes from an awful lot of information, modelling, data collection. It's a huge amount of resource goes into that, and it can be time-consuming and it can be difficult. And I think with these sorts of infrastructure issues, you know, they're really, really important. They can seem quite boring and they can seem quite unexciting in terms of how much resource you put into them,
important,
but they're absolutely critical. And we, you know, I can tell you from my experience at the OECD, the amount of resource we put into those sorts of things, you know, is high, and that is necessary to provide this information.
But I mean, you do have then some experience of building and designing these kinds of forecasting frameworks then from your
I have a lot of experience. Yeah, I mean, I have a lot of experience. You know, I don't build the models. You know, there are teams of people there that build these models, and my role is to, you know, talk to them about it, interrogate that, discuss with them the way in which that is done, and, you know, challenge, test, those sorts of things. I don't myself build the models. That tends to be a sort of team operation, and you need there's some real specialisms there, and it's important. And I think Dr. Bernanke talked about that as well in his report, the importance around maintaining and incentivising the building of these skills.
Yeah, he's made some significant recommendations in terms of the staffing, and so you will be directly responsible for that as well, will you? Yeah. And I think we're going to have quite a lot of other questions on some of the detail of your role. That's going to be it from me. I'm going to ask John to ask about the next set of questions.
Thanks, Chair. I'm going to intend coming to the issue of groupthink within the bank. But before I do that, can I just follow on from what the Chair was questioning about forecasting? I mean, you've made it clear both in your questionnaire and your response this morning that you're sort of defending the model in the sense that, you know, given the extent of the external shocks, you're saying that, you know, all models struggled, and actually the Bank of England's forecasts weren't that wayward compared to many other central banks. But I put it to you that, you know, that there is, and this committee has raised this issue several times with those appropriate individuals responsible, that there is a consensus that, you know, the bank was behind the curve well and truly when it came to inflation. The probably most extreme example being that, you know, just before the Ukrainian Ukraine rather, which is probably one of the largest external shocks, inflation was running at 6% and rising steeply, and still Bank of England forecasts were 0.5%, well behind the curve. I mean, you know, what I'm trying to put to you is that the bank was well behind the curve before one of the biggest external shocks. Now, you can't defend that, can you?
I think if you take yourself back to the autumn of 2021, which, you know, in the lead up to the Ukraine war, which is the period you're talking about, I think at the time there was a huge amount of uncertainty around what was happening in the UK economy, in all advanced economies. We were, as you say, we were seeing higher rates of inflation. This was a period where the COVID pandemic was sort of still with us, and you know, we were coming out of that and recovering from it. The inflation that we were seeing then was very much driven by a sort of a combination of the bounce back in demand that came as those restrictions ended, and then a sort of rebalancing of demand basically from services to goods, and this real bottlenecks we were seeing in supply, very strong demand from the US, for example. So you had that on the one side, and what was very difficult to predict really was how long that would last and what the implications would be. The other side, if you think back on one of the things that, you know, I was thinking about a lot is what was going on in the labour market, which was really difficult to judge because the furlough scheme had come to an end in that autumn, and what was going to happen to the people who'd been on furlough was very unknown. There was, you know, over 1 million people. Would they re-enter the labour market? Would they go back to their jobs? Would there be a rise in unemployment? And so you can see there were these sort of conflicting pressures, risks.
Could I just, if I may, could I just put it to you, Ms. Lombardelli, that even so, I hear what you say, but the bank was so far behind the curve. I mean, this wasn't just the fact that inflation was hitting 6%, it was rising steeply. We had money supply figures clearly showing some 12 months earlier the steep increase there, and yet the bank, for example, doesn't pay much attention to money supply figures as a precursor to inflation or deflation. But the bottom line is, well behind the curve, inflation rising steeply, and then Ukraine hits, when inflation had already hit 6%. And the reason I raise this is that it worries me when we hear from the bank that actually, you know, it was the modeling's performed like, you know, most other models, and you defend the modelling system. We agree with you that the Bernanke review is positive, but I just struggle with, and this leads me on to groupthink in a minute, struggle with your defence of the scenario. I would have felt much more comfortable had you come in and said, yes, mistakes were made, we were a bit behind the curve, it's clear, the evidence clearly suggests that, the city knows that, the bank was behind the curve, so far behind the curve, we had 14 consecutive increases in rapid time, the fastest in the bank's history, certainly outside of wartime. We're looking for fresh thinking here, but I'm not getting that sense from you, if you'll excuse me.
I think where I would challenge it, I don't think this was an issue about the models, if you like. I mean, the models clearly were struggling, but I do think there is a risk that people they put in interpreting how all economic policymakers, you know, whether they are monetary policymakers or others, how they use models. And there is a really important role for models, and particularly the forecast itself plays a huge role in communications. I do think part of the science and the craft of economics is knowing what models to use and also when, and understanding when they are struggling, and then at that point saying, well, what else do we need to be? I mean, you're always looking at huge amounts of data, but there are times when models are struggling, or where things are happening that are outside the sample, and you look more broadly then, or you talk to people, go around, you listen to what businesses are saying, and think about how all these bits of information fit together.
What you're saying, in effect, is that before Ukraine, before that big external shock, you don't think the bank was behind the curve?
I wasn't a monetary policymaker at the time. I understand, there were these sort of competing risks at the time. that all central banks were struggling with this balance between what is going to happen to activity and what is going to happen to inflation. I don't think it's the decisions that were made were reasonable given the balance of those risks at the time.
So, in short, you don't think the bank was behind the curve?
I think it's perfectly understandable that the balance of risks at the time was interpreted the way it was.
Okay. You appreciate the importance of this line of questioning because this affects everything from, interest rates in the real economy, the borrowing rates for economy. People's livelihoods depend on this issue, on the bank meeting its mandate of keeping on top of inflation. And I would suggest to you that it was well behind the curve, even before Ukraine. But let's move on. Your appointment as Deputy Governor means you join your predecessor as Chief Economic Advisor to the Treasury, Sir Dave Ramsden, at the bank's top table. And you also know that Cunliffe also spent the bulk of his career at the Treasury, and he only recently departed. Does this apparent trend risk blurring the line between the Treasury and the bank?
You will have 2 people on the Monetary Policy Committee, that's 2 out of 9 who've previously worked at the Treasury. I think that's not particularly unusual if you look back at what's happened, the composition of the Monetary Policy Committee. I would also say it's not unusual if you look internationally either. It's actually understandable that people with experience of policy making in a more fiscal policy environment and the economics and the economic analysis that goes into that, that gives you a lot of skills and experience that are relevant and highly useful for monetary policy making, which is why across the world actually we do see quite a lot of overlap here. I also think a real strength of the MPC process and the MPC structure is, it has this quite unusual 9-member committee of which 4 are external appointments. They can come from all sorts of different backgrounds and we do have a real range of people, market experience, academics, people with built their careers at the bank, people who are external, including people with other experience, including from the Treasury. So I don't. You will have 2 of 9, as you say. I don't think that's either surprising or worrying. I don't think in any way it is a challenge to the operational independence of the Bank of England. The system there is set up in such a way, and the macro framework in the UK is very, completely clear on this and completely sound. The fact that I used to work at the Treasury and will now work at the bank, I don't think is in any way a threat to.
You will understand that the importance of having the operational independence of the bank, and I suppose this leads me into a further question about groupthink. You replaced Ben Broadbent, the only serving governor or deputy governor who had spent a significant part of their career outside the Treasury, the FCA, or the bank. Does this raise concerns, as far as you're concerned, about groupthink and the lack of diversity of experience at the bank's top table?
I think, there is a diversity of experience at the committee. As I say, you've got a whole range of different expertise and backgrounds there, and there have been periods when you've had more or less people with direct financial market experience. We also have Catherine Mann on the Monetary Policy Committee. She worked at an investment bank before this role. So we do have people with market experience. Also, the bank has a huge amount of markets experience. On the broader question of groupthink, which I agree, it's incredibly important, and this is about how do you make sure you're thinking about things in a way that brings a range of sort of ideas and perspectives. I think there's, I'll take this in 2 parts. I think there's the votes of the committee themselves and the 9 people on that and their background. And then, like I say, actually it's built into the structure of the MPC that you have this diversity, you have these people with outside experience, and that's varied over time who and what experience they bring. And all of us around that committee will bring different thoughts. And from what I've seen as the government representative, there's a very rigorous debate and discussion that happens there. The other side of it, I think, is also, and I think it's really important, is about how do you build different ways of thinking and challenge into the processes by which you are doing the analysis, doing the modelling, having the discussions internally in the bank around those things. And those sorts of, and that is also really important. You know, what data are you using? What is it telling you? Do people in this, you know, in the internal discussions, is it a comfortable environment for people to raise different views? You know, what is the culture around that challenge? And you know, that is something that I think is a challenge for the entire economics profession, if I'm honest. But it is something where I think progress, you know, you can structure and ensure that you are building that into your processes, and that is something, you know, I've done before at the Treasury and at the OECD, and I would look forward to doing again. So I think it is a really important part because, as you say, these are decisions that affect millions of people, and there's a lot of uncertainty around these decisions, and that's why what you want is a whole range of views, perspectives, challenge built in throughout.
I mean, I'm pleased to hear what you have to say about re-examining the processes, but I hope you also accept that one's thinking sometimes can be very much shaped by one's background and the experiences you've had prior to getting to the bank. And there is a concern that, you know, when it comes to groupthink, that we don't have enough sitting on the MPC table that's willing to think outside the box, if you like, willing to challenge. And that, in many respects, was shown in the lead up to, you know, Ukraine, when we felt that the bank was well behind the curve on inflation, letting inflation rip. Can you assure us that when looking at those processes and when looking at what Ben Bernanke has had to say, that there'll be a bit of a shake-up here? Because looking from outside, groupthink still prevails if you look at the background of all, or certainly the governors and the deputy governors that sit on the MPC, because there is that very close link between the Treasury and the bank. And that is one aspect of groupthink that we're concerned about, because it brings into slight question, at the very least, and I'm probably being charitable, about the operational independence of the bank.
I mean, I really don't agree it brings into question the operational independence of the bank. That is set out very clearly in the macro framework that the UK operates, and
it does encourage groupthink. That's the background. I mean, I agree with you. Everyone brings their personal experience to the decisions that they make. I mean, I would say also, you know, not everyone from the Treasury is the same. Not everyone from the bank is the same. We all have very different personal experiences here. And, you know, being honest, I can tell you as a woman who's worked in 20, 25 years in economics, you know, I tend to have, you know, I'm not like your average economist in lots of ways. Now, I think we all bring our personal experience, whether that is, you know, to those decisions. And the other thing that you asked is, you know, can I assure you there's going to be a shake-up in response to Bernanke? Absolutely. Right? This is a fantastic opportunity. One of the reasons I am so pleased to be taking on this job now is because of the scale of the opportunity here to really look at radically reforming what we do, you know, taking a fundamental look at it, being honest with ourselves about what are the ways to do this better. I mean, I would say with my sort of OECD hat on and where I started, you know, I think this is a great opportunity, and I would encourage other countries to think about doing it as well, because there's a huge amount that we can all learn from what's happened over the last couple of years. It's been an extraordinary period and extraordinarily painful for people, you know, and that there's a huge amount there. So, you know, yes, I can assure you this is going to look and feel very different in the future. Thank you.
Thank you, John. Therese.
Thank you. Thank you, Mr. Lombardelli. The OECD's February economic outlook, which you oversaw, warns that monetary policy needs to remain prudent, but adds that scope exists to start lowering nominal policy rates provided inflation continues to ease. So we're seeing inflation ease. When do you expect to see interest rates cut in the UK?
Yeah. So I should be clear that the global, the interim economic outlook you quote is a global forecast, and that policy advice is policy advice that we put out to, you know, all countries. In terms of the UK, I mean, look, I will join the committee in July. My first vote will be in August. Will be the August vote. I mean, the issue at the moment, actually in the UK, is not unusual here, is what we are seeing is you've got falling headline inflation, quite quickly. But if you look at what the composition of inflation and what's driving inflationary pressure, we are seeing more of inflation being driven by things that you might think could be persistent, so services prices, labour markets, those sorts of effects. Whereas, the falls we've seen have been the changes to goods and energy prices that drove it on the way up. So, on the one hand, you've got this question about how persistent is inflation going to be? What are these forces that are driving it up? And you saw today with the labour market, right? So private sector wages at 6%. That's much higher than the bank's target. So you've got, on the one hand, you've got that question, and then on the other side, you've got, what we are also seeing is that activity is being impacted by monetary policy, and we are seeing some loosening in the labour market, for fewer vacancies, those sorts of issues. So the question really is, how do you balance those two risks, basically, and what is the future going forward for that? I'm not going to put a date on when I expect the UK to start the process of loosening monetary policy, but it clearly is the case that will be the direction of travel for certainly for European economies. That's what we would expect.
Well, Mr. Barron's gone on about, was the bank too slow? And I know members of this committee have also said, are we being too slow in cutting? And the reason I go further is just trying to understand. I think the OECD did suggest that the US and Euro area will be the first to cut rates. And I appreciate you're not on that committee yet, but I think in terms of one of the things that's been part of the issue, the governor has been quite clear. He doesn't want to see quite such high wage rises, and yet we are seeing that. So it feels we're in an odd situation, probably not helped by the electoral cycle in that regard, that we've got the banker governor who leads on deciding what interest rate we are going to have, and yet doesn't want wages to go up. So, and is almost blaming wage rises as opposed to what the market is deciding needs to happen in that, despite the fact that unemployment, unfortunately, does seem to have gone up this month. So, trying to get that balance of risks, how are you going to what are going to be your key determination in how you make and come to that conclusion when you come for your monthly votes?
Yeah, sure. I mean, I would say, quite a lot has changed since those February projections, and in particular, we've seen quite a lot of news from the US in terms of what's happening there, and we've seen much more strength in the US economy, both on the growth and the inflation side. And so, that picture's quite changed in terms of the sort of relative views of the economy. You've seen quite a big difference between European economies and the US economy there. Your question about what would I be looking to see? I think it is the sort of data and analysis around these issues of persistence, really, or the things that we might think could make inflation persistent. So in particular, looking at things like, what is happening to services price inflation. That's a much more domestically generated form of inflation. What are we seeing there? The labour market is obviously absolutely critical, as you said, and what we're seeing on wages and also on quantities in the labour market. It's quite difficult at the moment. There's a few issues with the data, but it's looking at those measures and also looking at the real activity we're seeing in the economy and how much that is being affected. So, to talk in particular about, if you look at what's happening in Europe at the moment, you're seeing quite big impacts on credit from monetary policy. So I'll be interested. I'm not deep in the weeds of the UK data at the moment, but those are the sorts of issues that I'll be getting into and thinking about.
From what we've learned about monetary policy transmission during this hiking cycle, and we've had the COVID aftershocks, we've had the energy shock with the invasion of by Russia of Ukraine. Have higher interest rates actually had any impact on inflation at all, or it being factors beyond inflation rates and beyond interest rates that brought down inflation?
Yeah, no, you can see an impact of monetary policy tightening. You've seen tighter monetary conditions, tighter credit conditions, and you can see an impact on that, on activity. I'm again talking a bit more broadly about Europe than just the UK specifically, but I think the UK data is consistent with this in that you can see impact on demand. You can see an effect in the labour market, though I would note the labour market has proved to be incredibly sort of strong and resilient, and that is a very good thing. If we look back to what people were expecting or forecasting a year 18 months ago, there was a lot of concern about what would happen to unemployment, to the labour market, and so the strength of the labour market that we are seeing across advanced economies, obviously, hugely a relief and a very good thing. But, so you can see some impacts on activity, but no doubt, obviously, some of the, large chunk of the fall in inflation is because of those shocks that we saw to external prices and them falling away. We'll see, for example, this month the energy price in the UK will change. That will have a big impact on inflation.
So looking ahead with growth, by the way, I used to run DWP, so I always thought the forecasts were nonsense because I knew our policies would work. However, in terms of growth, there's quite a big difference between the Bank of England's viewpoint on growth for the UK from the OECD. What is the big differing factor between the two?
Yeah, you're right, there is. The OECD number is actually much closer, I think, to where, say, the Office of Budget Responsibility is in terms of, and I should say, the OECD will revise these numbers in May. The difference, I think, is around the judgment on the strength of the supply side of the economy. The bank, I'm not close to and haven't got into the weeds of their supply side judgment, but they have talked about this before, and they see in the data, I think, a lot of reasons to be concerned about supply side growth. The OECD a bit more positive about the scale of supply in the UK. The OECD does quite a lot of looking at factors that affect multiple economies and thinking about those. So one of the examples I think that the OECD will think about is, for example, migration, which has been high in the UK, and that obviously drives up the headline growth rate. So it's the supply side and what is going on there, I think, that drives much of this difference. Though I should say the forecasts are done in quite a different way. So there'll also be a whole set of methodological and conditioning assumptions and all of that drive the difference there.
Thank you. I'll come back to other stuff later.
Yeah.
Thank you very much. Just following on a little from those questions regarding growth, the government's 2018 modelling of the impacts of Brexit, which I believe you were overseeing at the time as the head of the government's economic service, found an EU FTA would reduce UK GDP per capita by 5% in the long run. Do you stand by that analysis that was undertaken now?
Yeah, I mean, look, there was a lot of that particular analysis. What it did was look at it. It took a very long-run view of the impact, and it looked at that and made some estimates there. And it did that it looked at a series of scenarios, if you like, one of which was the free trade agreement that you described. If all of the conditions in those scenarios held, then it was a perfectly plausible estimate of the impacts. Of course, actually, how the relationship has evolved wasn't actually in line with any of those scenarios, nor would you expect it to be. But do I stand by that was a piece of sound, rigorous analysis that showed you if you make these assumptions, what outcome do you get? Yeah, that was reasonable. It's not out of line with many other studies and analysis that people did at the time. I mean, it's very hard now. That was 2018. The referendum was 2016. Obviously, what's happened to the global economy since then has just been huge, and so you can't really disentangle any of these effects. But as a piece of sort of economic analysis, sure.
And sort of looping back to Dr. Coffey's question, you noted in your questionnaire that the largest difference between these forecasts from the OECD and the bank is likely due to the OECD taking a more positive view about potential supply growth. Why do you think that difference exists between the two forecasting models?
Yeah, and look, as I say, I'm not close to the bank. The bank puts a lot of effort into its supply judgment, and I'm looking forward to getting into that. I think the differences will be, as I say, a number of things. I suspect migration might play a role in it. The very high numbers of, the large impact, if you like, from the numbers that you've seen there. I mean, also the OECD. Focuses a lot on supply side analysis and what we call sort of structural reforms, and so it will have it will have been thought about and considered a lot of the reforms that have been put in place there. I don't know the precise detail of why the bank's number is lower, but it's the sort of issue that I'm looking forward to getting into.
Sure. And when the Bernanke review suggests that the bank could benefit from an increased focus on issues to do with productivity, trade, labour market activity when it comes to forecasting. Do you think that there are lessons to learn from the way that the OECD produces some of these projections that the bank could potentially take forward?
Yeah, I mean, you might expect me to say this. I think the OECD can provide a huge amount of analysis and information on the structure, what we call the structure, so the productivity issues, those issues that you allude to, trade, those sorts of things. I mean, it's got a lot of, that's where its real expertise is particularly on these issues that we think affect growth in the medium and long term. And that's, so I think, you know, there's a lot of opportunity there for us to think about and for me to bring some of that knowledge and expertise into this process. I mean, a lot of these issues around productivity, I would say, are very long term. And so while they do affect, you know, short-term forecasts in some way, the monetary policy horizon tends to be a bit shorter, but there's certainly a lot I think we can learn about the supply side. And we should, and I think this is an issue that economists across the board are thinking about much more, is the supply side of the economy. One of the things we've learned a lot from the shocks that have happened is actually what happens on the supply side of the economy is very, very important, and we need to understand it a bit better and think about it a bit more in terms of both, you know, what is the data and what is going on, and when you go around and talk to people about their businesses and their choices, what does that mean, but also obviously the analysis, the modelling, the more technical work. But yeah, I think there's a good opportunity there.
And I was wondering if you had a view on whether you thought that the bank publishing its own forecasts for interest rates in the longer term might allow it to make more accurate forecasts as to the kind of concurrent growth rate.
Yeah, I think this is a really important question, and I'm really glad actually that Dr. Bernanke sort of raised it and opened it up. I'll be honest, I haven't come to a decision on what I think about it. I mean, I only read the review over the weekend, and I haven't talked to, you know, I haven't talked to Dr. Bernanke, I haven't talked to the staff, I haven't talked to market participants, I haven't talked to others about this. So I'd like to do that and listen to what people think about before I take a firm view on it. I can see, you know, there are sort of advantages around this. It allows you more, might allow you consistency with what you're doing. It would provide some clarity. There's also challenges to doing it as well around, you know, what does that do to expectations? How much does that anchor? I mean, it's interesting if you look around the world, you know, some central banks do this, some don't. There's not really a sort of consensus view on, you know, it's not obvious that there's a best way of doing this. So that's the sort of thing that, you know, I look forward to getting into. It's quite a complicated issue, and I think it needs quite careful thought. So with apologies, I'll come back to you on it.
To move then quickly to QE and QT, you were Chief Economic Advisor at the Treasury during the pandemic when the bank carried out £450 billion worth of QE. Did you take a view on its effectiveness then, and do you have a view on its effectiveness now?
I didn't, in the sense of, you know, it's for the bank to set monetary policy independently. It was the judgment of the MPC that this was necessary. The Treasury has an important role in the governance around the indemnity. You know, they took that, the bank took that decision for a set of reasons that, you know, you look back at what was going on through that period, you know, 2020 and the COVID pandemic. It was an incredibly challenging time for the economy. Perfectly understandable that policy lever was used in the way it was. So, you know, I can completely understand that, and you know, it makes total sense that they would choose to use it. And from the Treasury point of view, we were comfortable to indemnify that use.
And in your questionnaire response on quantitative tightening, you said that it had a limited economic and financial impact, but warned that we shouldn't assume that the economic effects of QT in the future will be the same as those that we've observed to date, and it'll be important to continue to monitor its impacts. Does that hint of concern or potential scepticism about the future efficacy of the impact of QT?
No, I think it hints at, or it's sort of revealing my view. You know, this is quite sort of new territory, and it's quite uncertain. I don't have specific concerns about it. I just think, actually, you know, this is quite a big change to economics and markets, and we have to think about that. And what the data that we have so far on the impact of QT is very, very early. I mean, you know, the specific, the way in which QT is being implemented by all central banks actually is specifically designed to have very limited effects. You know, this idea that it goes on in the background, the interest rate is the main lever. And that so that actually is almost designed to not give us very much data on how effective it is. That I think, by the way, to be clear, that's the right thing to do. You don't want, we should be the sort of careful and considerate approach that everyone's taking of doing this sort of slowly with a lot of transparency around what is happening is the right one. But it does mean we don't have a very wide data set on which to go on. And, that's why I think this is one of those areas that I suspect there'll be a lot more research over the future. There should be, because as different countries do it in slightly different ways and they have different circumstances, and also the economic environment will change. We're doing it now in this environment. In future, other things will happen. So I think it's an area where, because it's quite new and because we have limited information at the moment, it's a good area and an important area that there's more research and analysis done, and that we keep on top of that and make sure what we're learning from that we are feeding into the decisions that we're making.
Thank you. Thank you, Chair.
Thank you very much, Keir. Stephen.
Good morning, and thank you for coming to give evidence this morning. In your response to question 10 in your written questionnaire, you said inflationary pressures started to mount globally and in the UK in the second half of 2021, and you noted UK CPI had risen continuously from 2% in the summer. I'm sorry to go back to this, but it's really key. Why was it the bank didn't move rates until inflation was at 5% much later in the year? Because if the argument is the two major concerns. One is it was slow on the way up and therefore maybe slow on the way down, as you will understand. And secondly, in your response to question 15, you talk about the transmission mechanism, which I want to come back to in a moment. But if the argument from the bank, which it was at the time, that this was transitory inflation, and given you say the transmission mechanism is 18 to 24 months, on that basis, if you really believed it was transitory, why do anything at all?
So, well, I think you're getting to the heart of this. So the inflation that was during, the bank and the decision makers at the time will, have other people to ask. But from my perspective, the inflation that was seen at the time and the discussion that were going on, the inflation at the time was of a particular nature because of what was driving it. It was being driven by these changes to goods prices and the impact of that actually on energy prices. And so you were seeing those changes. There were reasons to think that might be temporary. You would expect, we were seeing this huge rebalancing of demand across the world, and also we were seeing the reopening of economies, and so you would expect patterns of economic activity to adjust, to change to that, and therefore, where prices are going up, more activity to...
But with a surge of pent-up demand from restraint, which was also adding to the supply-side shock,
yes.
Which was...
That's right.
Making the whole argument question mark about transitory.
Well,
no, was it being embedded in the system?
Look, I'm not. There was a huge amount of uncertainty, right, at the time, and how much there was clearly pent-up demand because of the end of the lockdowns. There was also, in a sense, a lot of uncertainty about supply because those lockdowns were affecting supply, and particularly if you think about China, right, it's a huge supplier of goods to the world economy, was in lockdown for much longer. Excuse me, but. It wasn't clear how long that pent-up demand would last, actually. Were people going to go back to their behaviour post, once all of the COVID restrictions lifted, would we have expected people to go back to their previous behaviour? Or actually, were we seeing structural changes to the patterns of consumption? Turns out, actually, we've seen a bit of both, but it was very hard, if you think about it, it's very hard to know. There's a lot of discussion at the time, is this, are we totally changing the way we do leisure, the way we do work, all of those sorts of things. So I think, on the one hand, the bank's view or the judgment taken was one around this transitory nature of inflation. Would it be or wouldn't it be? And then on the other side, this question about actually what is the risk to economic activity and employment and those sorts of issues where, again, there was a lot of uncertainty. So I think, there was uncertainty around all these things. The bank took a series of judgments at that time. If you think about what was going on in economies, there was perfectly reasonable series of judgments, and it is ones that actually a lot of people were taking, whether that's other countries around the world. We saw that other economic forecasters and commentators.
You understand there's real concern from any number of other economic experts that the delay in moving rates at that stage is causing other problems.
So the delay in moving rates in 2021 was causing... throughout the I mean, unemployment was obviously rising at the time, but actually if you think about some of the concerns, some of the uncertainties around, in particular, the end of the furlough scheme, there were worries that would prove to be, it was just very unknown what was going to happen. And actually the labour market did prove to be more resilient than some people feared.
Can we move on to the labour market? Because you, again, I think in your current role, the FT has recently quoted you as saying the UK has a particular issue about the labour market, which is exacerbating inflation. Could you set out the rationale for that view?
So, the challenge, I mean, all advanced economies are seeing changes to the labour market, right? We've got a lot of structural change that is going on. What appears to be, and in particular, labour markets are incredibly tight, right? It's just a lot of demand for labour at the moment. As I say, this is very good. We've had a very slow economic period around the world, in particular across European economies over 2023. That wasn't accompanied with the rise in unemployment that we might sometimes see, and that is a huge relief. But this question about sort of labour market, labour supply and participation, it looks like that is, we've seen a fall in participation rates in lots of countries, but it doesn't look like it's greater in the UK, and also it's a greater issue in Germany as well. I think
this is an extraordinary structural move that, quite. Do you see any evidence that participation rates are likely to increase over the next 2 years?
Yeah, I haven't. I'll be honest. I haven't looked in detail at the latest UK specific data. I think the government has actually a number of measures have been taken in this space in budgets. While I've been away, and I understand. That they've actively focused on this issue and trying to address some of these issues. And I think the OBR have done estimates on the impact of that. That. This is the right issue to be focused on, labour participation. I mean, it's hugely important. With my monetary hat, I'd say it's important because it is a constraint and a pressure on inflation. As a sort of broader economics hat on, I would say it's also a huge economic issue and a really important one if we think about not just people's economic prospects, but also their kind of welfare and well-being. And increasing participation is very important, and also an important part of what a lot of countries need to think about in terms of thinking about demography, which is another issue that is very increasing in its impact on labour markets. So the participation, it's the right thing to focus on. The government's taken some measures. I don't have personal estimates of the impact of that, but I know the OBR have done that, and I think that's it's the right thing to be focused on for sure.
I think it's probably your most recent economic outlook, the OECD talked about the concern for inflationary pressures from companies increasing margins and expectations of increase in wage rates, and you called it greedflation and the need to remain vigilant. Is there any evidence that we haven't seen that increase in company margins as yet? And do you think that we still need to be as vigilant as that as you were suggesting in February?
Yeah, so actually the work that you're referring to is when I first was earlier on. It's actually about a year ago. We were doing this analysis on the margins, the increase in wages and the increase in prices. And what it showed sort of across most economies is what you'd seen was initially in response to inflation, actually you were seeing a rise in margins, and then later on you would expect less of that going to wages, and then over time what we've seen is wages making up a larger component of it. That is actually quite it's sort of what you might expect if you think about how prices and wages adjust, which is prices can go up, tend to go up quite quickly. Wages, particularly in a lot of European economies, actually have a much slower sort of bargaining process or adjust over time. So we did see originally in the start of the inflation period more of this, a small component of this being about wages, and that is now adjusting. And you can see that in the real wage data, which we're now seeing rises in real wages as people begin to recover some of that.
And the UK isn't particularly different from any of the G7 in that?
Not particularly, no. Slightly different dynamics in Japan, but we'll keep moving.
Just one final question then. So I think in your February forecast, I think it was February this time, you said that you thought the US and the Euro area would be the first to cut rates, and that the UK might be slightly slower fourth quarter this year rather than second, third quarter. Given that the UK is broadly in line with the rest of the G7, do you think there's any revision to that view in terms of when the UK should start cutting rates?
Yeah,
or is there any change in the chronology?
No, I mean, I wouldn't, as I say, I wouldn't overweight a judgment in February about prospective interest rate changes and when they may be. I mean, the big change is the further divergence between the US and European economies, and so the outlook for US interest rates and US inflation and growth is quite markedly changed now. So that comparison is different, and with a general market expectation now is that you'll see European economies moving sooner potentially than in the US, and that reflects the growth in the unemployment data, the growth in inflation data.
Is my time up?
Feel free if you've got another question to ask one more, and then.
Can I just then go back to the transmission mechanism, because obviously that's key to the efficacy of monetary policy in terms of rates. Do you still see that 18 to 24 months? It's quite an increase against traditional classic economics, and it may well fit modern day scenarios. But of course, with the structure of labour markets, structure of labour markets and the structure of mortgage markets, if it's actually taking 18 to 24 months to work through, then the impact of rising rates now may be having an impact quite later in the cycle when other things have quite markedly changed.
I mean, it's clearly the case that there are lags in the transmission mechanism. I haven't seen the sort of latest estimates around it, and so I haven't seen evidence that would make me think it's definitely changed from 18 to 24 months. I do think we need to be very cognizant of the fact that there's quite a lot of structural change going on in economies at the moment, and so you want to think about that and come with quite an open mind, I think, to these sorts of things. We also will have learned quite a lot from these shocks that we've had and the way they've fed through the economy. So, I haven't seen any evidence or reason that I would move away from that in one direction or the other, but I do think it's worth us having, just making sure we are learning everything that there is to learn from the recent experience and also the structural changes that we are seeing, as you mentioned, labour markets, but also quite a lot, as you say, around, the way mortgages transmit through, the way other corporate borrowing rates transmit through.
Thank you, Stephen. Angela.
Thanks very much. I want to talk a little bit, Ms. Lombardi, about financial stability and come on to talk about non-bank financial intermediation and the problem that might cause. But firstly, we are working at the moment against, we've had fairly reasonable political agreement for a while on the structures of central bank independence, the Monetary Policy Committee and how it works, but I sense that is beginning to break down. Do you think that we've got the right kind of structure?
Yeah, I think I wouldn't recognise the description of it breaking down. I think the macroeconomic framework in the UK is actually very clear and is very stable and has proved to be. I think, certainly through all my time at the Treasury, this was a system that operated with complete sort of commitment to it from all sides.
The breakdown is coming politically. Just yesterday we had former Prime Minister Liz Truss saying that the governor should have been sacked for what happened in the aftermath of the changes she made in her mini budget in September 2022. Do you think that that's a sign that there's widespread agreement about the structures? She's calling for the governor to be sacked.
I think I do think there is widespread support for this structure. Obviously individuals will have different views on this.
Wants an inquiry into what happened in the aftermath of her catastrophic mini budget, and she's been touring the TV studios blaming absolutely everybody but herself for what happened.
I mean, I mean, the events of that, September, October 2022 were examined actually by this committee. There's been quite a lot of evidence provided, and some of your questions actually, provided transparency around that event. So I think there's quite a lot of information around there about what happened at that time, and a lot of evidence was provided to this committee and other committees on it.
I think the OBR should be abolished. Do you think the OBR should be abolished?
No, I'm a big fan of the OBR. I've worked with them and saw the benefit of them, of their role and the role that they play, over many years. It's very valuable to have that independent expert judgment on fiscal policy.
And what do you think the signal given by sacking the permanent secretary at the Treasury was responsible for financial stability prior to the catastrophic mini-budget gave to the markets?
I think this is all well-trodden territory in other circumstances.
So the measures announced by the mini-budget took the bank by surprise in 2022. What scope is there for any improvement in the communication channels between the bank and the Treasury? I suppose it helps if the Prime Minister actually believes that she should share this information. There were challenges. It was a very unusual process that ran through that period. Not around the MPC. I mean, the MPC processes were as they were. I attended as the government's representative. I shared the information that was available. What was unusual was the two things I would say: the speed with which that fiscal event was being put together, and given the size of the changes in it. So it was a large fiscal event, and the lack of an OBR forecast changed the process, because if you have an OBR forecast, you have two things really. One is it changes the timetable by which you're operating, because you have to. The OBR need the information of what's in the analysis and calculations, and what that means is the package effectively of measures is settled. So if you have that was missing from this event, and so that meant that that there was less information available. The process. Why do you think the markets reacted the way they did? Well, I mean, they were also surprised, it seems, by the content. By perhaps the content and perhaps the approach. I mean, it was an unusual process, and your question, how could you change it if operating the normal process with the OBR? It doesn't raise these problems. So I assume from that point of view, I mean, the governor said he didn't know what was in the budget, and then he had to deal with what happened in the LDI markets. Do you think that that's any kind of way to try and get cooperation between the different bodies that are responsible for running financial policy making and fiscal events?
As I say, there's actually very good, working relations between the Treasury and the bank at all levels on this, all levels on these events, and the processes there are very clear and are in place and work.
Was this the deep state at work?
I think these events have been well covered, if you like, in other inquiries and hearings. What people were doing was their job, whether that was at the bank with an eye to thinking about financial stability and monetary stability or elsewhere.
So you would like the structures that are around for central bank independence, the OBR, the way the Monetary Policy Committee works, those structural parts of the system to remain pretty broadly as they are, even if policies might change or the way that financial models are designed might change. You think that is a reasonable structure within which to operate fiscal and monetary policy?
It's for the government to set out the macro framework. It's not for me, and certainly not for me in this upcoming role, to do that. Those are decisions for the government, democratically elected, scrutiny from you and others to do that. The arrangements that are in place currently and have been in place, since 2010 for the OBR, since earlier for operational independence of the Bank of England 97, have served the UK well in providing a stable environment for decision making.
Thank you very much. Looking forward to potential issues in the future, the bank's financial stability report in December 2023 states that, and I'm quoting, the underlying vulnerabilities in the system of market-based finance remain largely unaddressed. How can that current situation be changed in the future?
I think the bank is undertaking a lot of work in this space. I mean, it's no doubt that the increasing complexity of financial systems and the increasing use of sort of non-bank financial intermediaries is changing the nature of risks and changing the landscape. And this is an example of that. The bank is doing a lot in this space and continues to do so, whether that's different stress tests. They've got this system-wide exploratory scenario, for example, that they're undertaking at the moment that looks at actually what happens to a whole range, not just banks but beyond, in terms of what happens if you stress the system, and that will reveal a lot of information about where vulnerabilities are. One of the challenges in a lot of this space is around information and transparency, and so the bank's undertaking quite a lot in this space. That's an important programme of work that the FPC is working on and will continue to.
In the aftermath of the financial crisis, when by definition part of the response was to have greater supervision of banks and increased requirements for deposits and the rest of it to make them safer, we seem to have created a situation where the shadow banking system is booming and growing far faster than the banking system itself. But yet is directly connected by non-bank financial intermediation to the potential stability of the regulated sector. What is the right balance, in your view, between the non-bank shadow sector and the regulated sector? And is this growth in the non-bank sector just a way of getting around the rules in the regulated sector, and does it present, therefore, increasing financial risk in terms of financial stability?
Yeah, I think the drivers behind the growth in, if you like, the non-bank sector, it's not sort of driven, if you like, by regulation in the banking sector. It's a set of, actually, if you think about what it is, it's a whole range of very different, very diverse financial markets operate. There's a big difference between an insurance firm and a hedge fund and so on. So you've got a very diverse landscape. It's not driven by regulation of the banking system. It's driven by actually the sort of preferences and demand for different financial services, and that is evolving, and it will continue to evolve, including because of technology. And you can think about that. So, but it's definitely growing. It's now a much bigger part of the global financial system than it was around the time of the financial crisis, and that does create risks. Because, as you say, of the interactions between the two, but also of risks in these non-bank financial in themselves. Now, the right approach to that is, in a sense, to have appropriate regulation across the board for the banking system and the non-banking system, and more is being done in the non-bank system to deliver that. There's a lot of work going on internationally, and that's actually.
Are you in favour of regulating the shadow banking sector?
I'm in favour of regulation for different businesses and as is different financial institutions as is appropriate, to make sure that you have a safe financial system across the board. Clearly we need to have we need to ensure that we have financial stability.
And to what extent can transparency be mandated? Because a lot of the dangers in this area come from risky interconnections that might not be obvious, and obviously that kind of thing is what caused the financial crisis as well. So what can we do to mandate transparency and try to pull these hidden connections more into the light?
Yeah, it's a good question. Transparency is obviously incredibly important because you don't really know what you're dealing with unless you can see and assess the size of it, but also the interactions between these parts of the financial system. I mean, just to come back to it, it's why things like these system-wide stress tests are a good thing, because they will expose some of the interconnections that we might not otherwise have been aware of. In terms of transparency, I'm afraid I'm not a deep expert in terms of what is possible at an international level in that space, but clearly a lot of these issues can only be a lot of these issues are best handled internationally because of the sort of location and the interlinkages across the global economy on these.
So when do you expect when the bank says in its financial stability report last December that a lot of the underlying vulnerabilities remain largely unaddressed, when are they going to be addressed?
I'm afraid I can't give you a precise answer on that. I wasn't involved in the drafting of that report.
You'll be looking for them to be addressed.
Certainly, and I've no doubt actually that the bank is undertaking work at the moment. So I'm sure it's in the process of being addressed, and that others would be able to update you on that. Or
we know very much though how slowly international agreement on these things sort of proceeds, and meanwhile, as a country with a large financial sector, we're likely to be facing more risks than some if they do crystallise. So do you worry? Do you lie awake at night worrying about that?
Not yet, because I'm not sort of deep in the weeds of it.
You might once you've seen them.
I mean, what I would say is it is preferable to take international action because of the international interlinkages of these institutions, but it's not the only option on the table. And actually, there have been multiple instances where the bank has taken or has been able to take domestic action to shore up domestic parts of the system. So it's not an either or. And actually, you would take a balance of the two approaches. Of course, international is better because it provides greater resilience, but it's not the only option on the table. And so there is lots of things that the bank can do. The bank has a huge number of sort of levers in the financial stability space that it can and would use.
Going on to those levers in the financial stability place, do you think that the FPC has all the macro-prudential tools it needs to ensure financial stability?
I mean, it's got a wide range of tools. The bank is, and they are. There is work underway always on looking at and ensuring whether those are the right tools, whether more tools are needed. And at the moment, there is some work underway on exploring other tools and thinking about whether there are other, interventions that, sort of backstop interventions that could be put in place if needed in certain scenarios to widen the pool to widen the toolkit available, and also to increase. So that you might have some more nimble tools or some more appropriate tools. So that work's underway. It's not a fixed picture now. It continues to evolve, and in particular, there's some work underway at the moment on some of them.
What do you think? Finally, we can do to enhance global cooperation on the non-bank financial institutions to try to make financial stability a greater aim of all of the international financial situation, rather than the current willy-nilly growth and uncrystallised risks that are growing and hidden in various bits, like the liability-driven investment market, which the bank discovered in the middle of the mini-budget aftermath was a problem.
Well, I think there's a lot of activity that's happening on the sort of international stage in this, and the Financial Stability Board are sort of the people that sort of lead and coordinate it. And actually, the UK is a really big part of that, is a huge contributor and does a lot in terms of leading the kind of intellectual case, providing analysis and information, and pushing and shaping that agenda. It's a very active member and does a huge amount. And this is a big global agenda. I mean, you're right, it can take time to reach international agreements, but that's because actually, it's right to build consensus and get agreement for these things across a range. So I think the UK, actually, the UK punches well above its weight in terms of financial markets and regulation. It has a big impact internationally. It will continue to do so. You know, we're very respected in terms of the analysis, in terms of the work that we do, and also obviously, of course, we have a very large financial system. So I think we have to continue to push that agenda and work with others internationally to pursue it, but at the same time also think about what domestic tools that you have in place, so you have a kind of two-pronged approach to this.
Thank you very much. And can I just ask on this liability-driven investing point, in the beginning of September 2022, we did ask in this committee about whether the start date that was scheduled for quantitative tightening was something that could potentially destabilise the gilt market, given that there was a new government coming in with a clearly expansionary fiscal policy. And I think that the stress test that had been run on LDI in 2018 called for something that looked at something like a 1% sudden shift in the long bond. So is it part of your remit to look at all the stress test assumptions and just to see are they the right assumptions, or could there be some bigger moves that could potentially undermine financial stability?
Yes, that's the sort of thing the Financial Policy Committee would look at. So it's for the FPC, but I obviously will be a member of that.
Okay, great. But you're not going to be on the Prudential Regulation Authority, although your predecessor, Ben Broadbent, was. Discussing that with the Governor, what reasons did he give you for that being the case?
I think, look, I'm going to have my hands full with the Bernanke review and the implementation of that. You know, this is a huge piece of ongoing reform for the Bank of England. I think that is, you know, I can make a bigger contribution there, I suspect, than one of the many members. You know, but my time is better spent, I think, in investing on that. I think that's got to be the right choice. You know, this is huge for the bank and is huge for monetary policy making in the UK, and so, you know, I welcome the fact that I can focus on that a little more.
Okay, all right. And can I ask about the role of artificial intelligence and how you see that being used in terms of the bank's decision making or your decision making?
Yeah, sure. So, I mean, this is, I think, a fantastic opportunity in terms of, you know, artificial intelligence, new general purpose technology that we are all seeing kind of enter all aspects of our life. And if I may do a quick plug, the OECD is publishing a paper this morning on the economic impacts of artificial intelligence. In terms of its use within the economics profession and within the bank, it's as yet, I mean, you're seeing it being used, and we should distinguish between artificial intelligence and generative artificial intelligence. Artificial intelligence is being used actually very extensively in the economics profession, particularly around sort of data analysis and those sorts of things, in the same way that it's being used extensively across the financial sector and other sectors. It's quite widespread across the economy. But generative AI brings a whole new set of opportunities, if you like. It's not yet being used very extensively in the economics profession. A lot of people are thinking about it, playing with it. You're seeing it a lot in, for example, coding. People are using it quite extensively there, and of course people may be using it for the things that they're writing and the like. But in terms of using it for forecasting, for example, I know some sort of bodies have sort of been playing with it, but no one's really using it that extensively yet. I mean, my approach to these things, or my attitude to AI, is that it is very hard to predict now the uses that we're going to put it to. It is clearly going to give a huge amount of power and improvement to how we do things. I'll be very surprised, you know, if I'm, you know, if, for example, the forecasting that is done in the bank or elsewhere in 10 years' time doesn't look very different because of artificial intelligence and the role that generative AI may play in that. But, you know, it's very hard to sort of predict now, in the same way that, you know, when the personal computer came out, it was very hard to predict the final uses it would be put to, and I think people that try, frankly, will struggle to be accurate. So I think it's something we will use. I suspect we will use it, and we will think about how we use it on the data side, how we use it on the modelling side, how that plays into the forecasting. I think it's a great opportunity there, and we'll be looking to and thinking about how others in the profession are using it and what we can learn from that. But I do think this is, ultimately going to be transformative in terms of a technology for the whole economy, and that will affect the bank as it will affect others.
Okay. Final question for me is Basel 3.1. What's your view on the implementation of that in the UK? Would you be happy if the UK went ahead and implemented it, but the US and the EU didn't?
Yeah, so I mean, let me be frank, I'm not as up to speed on the Basel 3.1 implementation as I will be, when I get my feet under the table at the bank, so I don't really feel I'm well placed to give you an informed and meaningful answer on that at this time.
Okay, fair enough. Do any of my colleagues have any further questions? So we would just like to thank you for your time and declare this part of the session over. Order. Thank you.
Cheers.
Portcullis House, the Thatcher Room.
The proceeding has ended. 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 The proceeding has ended.